Hello and welcome to the NASGP podcast, The Art of GP Locuming. I'm Dr. Richard Fieldhouse and I'm joined today by Phil Bowler from Chase de Vere, who's a highly experienced independent financial advisor. And we're going to sort of do a run through from kind of almost beginning to not quite the end, but a financial planning when working either full-time or part-time, or sessions as that include working as a freelance, self-employed GP locum. So Phil, welcome to the podcast.
Hi, Richard.
Really good to have you. And so what I suggest we do kind of, I guess, is start from the beginning, really. So and we'll work our way through things like starting out as a GP, getting your first pay packet, starting to think about accommodation and insurance products and things about like pension and maybe planning with children in mind, and health and then finally sort of getting into actually taking that pension scheme out. So I guess if we start from the beginning again, how we should start as kind of newly qualified GPs starting to get some income in from some self-employed work. How do we start thinking about that in context of mortgages and life insurance, critical illness? What are our first financial priorities?
Yeah, it's a really good point in respect of newly qualified GPs. They've got a lot to think about, obviously, and thinking about their finances probably isn't top of their list, but actually is extremely important. They've probably got things like student debt to think about, but then they start getting their first wage packets, and at that stage, they need to think about, okay, where's this money going to go? How am I going to protect myself? How am I going to protect my future? And the first thing we very much talk to newly qualified GPs is about protecting their income. And it may seem, that's a strange thing to think about from a starting point, but however, your income drives everything. If for any reason you're unable to work due to illness, sickness, and you've not got any income coming in, then that's going to affect just not your situation, not just now, but going forward, even as far as your retirement. So protecting yourself while you're young, protecting your income while you're young is relatively inexpensive, and it's a good thing to do while you're fit and well. Because while you're fit and well, actually the cost of insurance is going to be lower. A lot of people think about it, unfortunately, when they have a period of off work due to sickness, and by that time it could well be they won't be able to get cover, or cover might be more expensive because they've had that time off work. You can cover yourself. They have things called like deferment periods, so you can get it. It's like slightly more inexpensive if you have a deferment period of 2 or 3 months or 6 months, which is a period before you actually make the claim. But obviously, you've got to make sure you can support yourself during that period if you're off sick. So certainly, that would be the first area we look at. Um, Other things are important as well when you're talking to things like pension. Now, that is really something that's really hard to get your head around as a young doctor, thinking, oh, do I really want to be saving my retirement? That's going to be 40, 50 years ahead of me. But again, starting young is really important. And the great thing of working for the NHS is you do have the NHS pension scheme. And the NHS pension scheme is probably one of the most generous pension schemes you could have access to. So it's really important you think about that, really important that you join that pension scheme at the earliest opportunity. You will have to
Fantastic.
pay. Sorry?
Yeah, no, that's fantastic. It's really good to think about it. That's sort of that very upstream. What's the beginning of and securing, making sure you've got the money coming in the first place is a really good way to think about it, I think.
Yeah, yeah. Um, and with the pension as well, it should become like a habit almost that you're paying that each month. There is a process to follow, especially if you're locuming. It can be quite a complicated process when you first start, and so it's important that you understand that process and follow that process. And one thing we might talk about later is making sure you keep records of everything. Um,
Okay.
because for how good the NHS pension is, their administration has at times let people down. And so it's important you keep records of everything that you do, so that if anything happens in the future and you can't find a record of your contribution, particularly later on in life, that you have that record to prove that point. But
That's
the pension
fantastic.
scheme
And
is a really
obviously,
good place to
for
start.
our NESGP members, we've built the Locum Deck platform, and that absolutely stores every single pension form they ever create, all there ready for them.
Absolutely. A system like that is just gold dust, especially when you're starting. So you've got that record, and that should ensure as your career progresses, if you have a look at your pension record, realize something's not quite right, you've got that record, and they can put that right really, really quickly. So that's a really good thing to have.
Fantastic. So you're talking there about income protection, and you mentioned deferment period 3 to 6 months. But you also said, but you got to make sure you could be covered for that initial period, that gap, that short term gap. Are we talking about savings? I've heard there are also some products sort of. They're sort of like a personal accident or sick leave products, which sort of so I know some colleagues have taken out. They've got it's kicked in after a few weeks of being ill, but it stops at 12 months, and then the deferred income protection then kicks in long term. Are those products still around? Are they advisable? What's a good
Yeah,
way to prepare for that gap?
yeah. There are different types there. So one is what we call a personal accident policy, which we don't really recommend because it only covers you for certain accidents. So you could be off sick for a certain condition that's not covered under that personal accident policy, and therefore you can't claim under it. So it's not really worth the paper it's written on. So we wouldn't go down that route. There are some policies where it stops after 12 months. You rightly said it will pay you an income, and it will kick in maybe after 1 or 2 weeks. Um, One thing that you need to think about with those products is you're probably better off having the full income protection policy and just reducing the deferment period to match any. Well, unfortunately, as a local, you won't have any sick pay, but as a GP later on, you may have some element of sick pay for your practice, depending on what your role is. But my recommendation would be to make sure you have what we call an emergency fund, just in cash, just to call upon. Now, early on in your career, that's going to be difficult. Appreciate that you're still building up savings, but over time, if you can have a element of cash that you can call upon, and we'd usually say at least 3 months worth of cash in a bank account, complete hopefully reasonable level of interest, still manage it so you're getting interest on that money, but that means that you can call upon that money in the short term. And if you've got, say, 3 months worth of that capital available, you could then have your policy, which would kick in after 3 months. So we have a deferment of 3 months. So then it would be protecting your income after that period of time. And that way it just keeps the cost down as well. Because if you have an income protection policy, say with just a 2 week 4 week deferment period, the cost does ramp up quite significantly because there's a good chance you will be claiming in that short term period of time.
And that's where I've my understanding of these income protection products is the longer the deferment period, the cheaper the cost. Is that right?
Yeah, that tends to be the case. Yeah. Yeah.
Yeah. Uh,
Um,
I think with in this financial climate, we have had a lot of colleagues, members struggling financially to pay the bills, let alone save. So I'm thinking, what is that period can be quite scary. And I remember that myself as a newly qualified GP, because also trying to sort of get ready for a mortgage, and all that entailed. That is rather sort of slightly winging it, and I think that's why we get a lot of questions about these accident and sickness cover for that bridge,
yeah.
that first 12 months or so.
Yeah. So, what one thing I would suggest is really important is that in that short period of time, yes, take out a policy with a much shorter deferment period. Yes, it's going to be a little bit more expensive, but over those next 12 months, you might then be able to accumulate an element of savings and then
Right.
review it after 12 months and see then if you can remove the deferment period out and replace that policy with a maybe less expensive policy. And this is where I'd always recommend an independent financial advisor because they'll go out to the marketplace. And what you might find is that one provider that provides you with a policy with 1 month deferment period might be difference in cost to someone that provides you a policy with 3 months deferment period.
All right.
So an independent financial advisor will go through the marketplace and find out the best policy for you for that period of deferment period.
Okay.
One other thing worth pointing out, Richard, when we're talking about policies and cost. One thing really important for GPs is to make sure you have it on an own occupation basis.
Right.
And
So
what that
what does that mean then?
So what that means is that if you can't do your job as a doctor, the policy will pay out. There's a lot of these policies. I mentioned about the accident sickness, which are really, I wouldn't be really going towards those policies because there are other income protection policies as well that pay out only if you can't do any jobs. You have to be pretty unwell. Really, you want a policy that's going to pay out if you can't do your job as a doctor. Yes, it's
Right.
going to cost a few pounds more, but as a young doctor, it won't be a lot more. But our own occupation definition is really, really important.
Okay, so that means that you could and that even works if you're self-employed, does it? Because
Correct. Yes.
yeah, good,
Yes.
good. I was going to
Yeah.
say otherwise, because you could just end up them saying, "Well, you can work as a cashier in Tesco, so off you trot," kind of thing.
Yeah.
Yeah.
Yeah. And there's
Okay.
some companies out there that provide specialist policies as well for younger doctors as well on a discounted basis. And they can sort of match changing deferment periods over time. So you don't always have to change your policy. But again, a good independent financial advisor will be able to tell you which of those policies are more flexible than others.
Yeah. Yeah. So on that subject then of just to linger on it just a little few more minutes longer on the subject of health, like I've just so breached the 60-year-old mark, and I 30 years ago, if I as a newly qualified GP, having worked in the local hospital, if I needed medical care, I found that quite the system quite easy to navigate. I sort of had friends and I could see a consultant very, very easily, and they would see me very quickly and all that kind of thing. It was like as a junior doctor back in those days, you got a bit of a concierge service because they wanted you back on the wards. Um, but nowadays, I that obviously that doesn't exist anymore. I'd be really surprised if it does. So I've again conversations. I've come across quite a few GP locums now that I know who've actually taken out health insurance products to cover themselves and their family, to go down the private route because they've just found the NHS so difficult to navigate. They're so used to the
Yeah.
nuances and current state of NHS that they find that really beneficial for them. So again, if I was starting to think about health insurance, where should I start?
Yeah, so the thing about health insurance is not what we call a regulated product. So,
Ah,
from a financial advice point of view, our advisors, for example, wouldn't necessarily recommend individual health products as such. There are a number in the marketplace, and I think that the real benefit of those for doctors is very much for things like joint issues, I suppose, and getting physiotherapy and all the extra benefits that they offer along the side. I think it's really important getting you back to work as quickly as possible. But from that perspective, really, it's a question of going out to the number of providers that are out there and just trying to find out, first of all, the cheapest quote, and they do review it each year. Um,
okay,
and different policies will be based on claims history as well. So you need to be aware of that. If you are making a claim, you might find your renewal is going to go up in price as well. So
right,
you think about that, but it really depends on the provider. It's, as I
okay.
said, it's not something, a regulated advisor will provide specific advice, but they will certainly point you in the right direction. And it makes perfect sense to have a cover like that alongside your income protection, but it's not something to replace your income protection. That's the important thing to
No, no,
understand.
no, no. And so out there, there are kind of like there are still travel agents, go to travel agent, and they can help you help you pick a destination. There are health insurance brokers who can do the same. They
Yeah, you
okay.
can find them, or you can even go on some of the compare websites actually,
Oh,
and they
okay.
compare the benefits as well. So there's a few on there as well. So that would probably be the best route to go. But a good advisor as well will point you in the right direction. You just need to be aware it's not regulated, so you don't have the same protection when you're sort of being advised on those products as you would with something like an income protection or a pension policy.
Okay, great. Um, so the next thing, really, I suppose, this segues nicely into is talking about the actual uh, pension scheme, and let's predominantly talk about the NHS pension scheme first, and maybe dabble with some private pensions on the subject of private pension schemes. Obviously, within the Locum Deck platform, we have got completely built-in automated electronic NHS pension forms for locums, locum form A's, locum form B's, and all that sort of thing. And actually, don't know if you know this, Phil, but when we started NASGP, we actually fought for and won NHS pensions for GP locums. We weren't before NASGP, we weren't able to access that, but obviously can now. Um,
That's really good
but
to know.
yeah, so it's so talking about, should we, shouldn't we, I guess basics of how we do it if you're not on locum deck, but also people, there've been AVCs, voluntary, additional voluntary contributions. Those are, and there are other bits of add-ons for NHS pension as well, and should we be chucking in, bearing in mind we've got income protection, we want to think about a mortgage, we've got student loans, should we start to be making ourselves slightly even more cash poor at this early stage in our careers, and chucking it all into a pension scheme so it benefits us when we're older? Where do we stand with all of that?
Okay, so quite a lot in that question, Richard.
Yeah,
Try
sorry.
and get my head round, but yeah, I'm I'm quite pension orientated, and I when I was young, I was a bit of a nerd and put lots into my pension, and a lot of my friends thought I was mad. But it's put me in a very good position now as I approach retirement that I can make decisions. However, that you have to have other priorities, and a really important thing to understand about any pension provision is you cannot access that pension until currently it's 55, but it's soon to be 57 or 10 years from your state pension age. So if state pension age goes up, it'll again, the minimum date you can take your pension will increase as well. So for most people, younger people, it's going to be sort of 57, 58 before they can physically take that pension. So you need to think about, you are tying up the money. However, there is not another product that is financially or as a tax efficient as a pension. You get tax relief on the way in up to your highest rate of tax. And you also, in respect of getting the money out, you get a tax-free lump sum as well. And if you're talking about a private pension, it's 25% of the fund value. If you talk about the NHS, there is a maximum amount which, because the NHS pension isn't what they call a funded pension scheme, without going into too much detail, but you could also get a lump sum out of that pension, which is tax-free. So there's lots of tax benefits, and a private pension as well grows tax-free. However, that all sounds great. The private pension sounds really, really good, but the guarantees associated with the NHS pension are huge, and therefore really, really valuable in having those guarantees. So, in my opinion, nearly everybody who works for the NHS should be in the NHS pension scheme as a starting point.
Okay.
There are a very few exceptions, but are very few, and probably ones who are earning significant amounts of pensionable income where they have tax issues. We may come to that later, that there is a very small amount who maybe want to consider opting out of the scheme. The vast majority of people, and I would, really encourage all young doctors, particularly because some of them are opting out, to join the NHS pension scheme because it is so tax efficient, and the growth you get on your money is just unbeatable.
Right.
That's really important.
Yeah.
So that is really important. But then people think, well, should I put more into my pension? And again, if you've got the capability, you've got the available cash, and you're prepared to tie it up long term, yes, put it into the pension. It then becomes what option? You mentioned about AVCs. You've got something called additional pension, which is
Oh,
linked
yeah.
to the NHS. You've got personal pensions. You've got SIPs, self-invested personal pension. There's quite a selection out there, and choosing the right option is going to be different depending on what you want from your pension. However, the additional pension part is really, again, really quite good from a cost effective perspective and a guarantee perspective. And you can purchase in England, it's, up to another 8,000 plus of pension by paying an extra amount out of your salary each year.
When you
And
say buying an additional 8,000, does that mean 8,000 lump sum at the end, or how does that?
£8,000 per annum pension.
Oh,
So it's
okay.
actual income. So
Right.
what you'll do is you're paying, and at the moment, a doctor will pay a percentage of their income towards their NHS pension. And if they want to pay more towards it, they'll increase that percentage and pay it towards their additional pension. Depending how much they pay, depends how much additional income they can purchase at retirement. Um, and the amounts are quite high. But again, you need to think about affordability, and you also need to think about pension taxation, potentially as you get further through your career as well. And then you want to think about flexibility. Now, if you're the sort of person that's thinking, when I get to sort of retirement, I'm probably going to maybe do bits and pieces. I'm not too worried about regular income, but I'm going to want to pick and choose where I want to put my money. Then something like a private pension or personal pension might be better because there's flexibility. You can draw bits here. You can draw maybe 10,000 one year, 20,000 next year, leave it for a couple of years, then draw some more. Whereas the additional pension, you're just going to have a regular income being paid to you month on month alongside your NHS pension. So it starts talking very much about objectives and retirement objectives. That's why it's quite difficult for young doctors
Yeah.
particularly to start
Who
making
knows?
decisions because they don't know exactly.
Yeah.
But as you progress through your career, you can then start to pinpoint, yeah, this is what my objectives are, and this is what pension is right for me, depending on what my retirement plans are.
And in your you've been doing this job for a long time. You've a huge experience. You would have seen dozens, hundreds, possibly thousands of clients over the experience of. When it comes to the NHS pension and additional contributions, have you ever, looking back, have you ever come across people who've kind of regretted buying more NHS pension and they thought, oh, that was a stupid idea. Why did I do that? Has that ever happened?
Um, I wouldn't say that's happened. Historically, when the government decided to introduce pension taxation, so annual allowance tax, that actually caused an issue for some of the really high earners who had bought something called added years, which was the predecessor to additional pension. And that added years was a fantastic benefit, but what it did, it over time, it accumulated your pension at a higher rate for high earners, which meant they ended up paying additional tax on that
Okay.
benefit. Um, but for the vast majority, no. I would say that most people have seen that as a huge advantage. And and from my perspective, it's just asking, am I going to need that money? Am I going to need it? No. I'm going to need it when I retire. Probably. That's the decision. Yeah, that needs to
Yeah.
go to pension. That's the most tax efficient way of doing things.
Okay. That's really interesting then. Um, Great. So I think you've covered very nicely there that yeah, get the ball rolling as soon as possible. Um, so let's just um no, when I go into private pension, it's a little bit more about private pension than if someone was, if for our high earning listener out there, I'm sure we must have a few, but maybe not that many. Is you is that something we should start asking our independent financial advisor about, or maybe leave
Yeah.
that for now?
Yes. So for those individuals thinking, actually, yeah, flexibility is really important to me. Private pension is a good option. You get tax relief on the way in, so tax relief at your highest rate. So if you're a 40% taxpayer, you get 40% tax relief. So you need to claim that back through your self-assessment. Um, your pension is going to grow tax-free. And when you reach that minimum retirement age, you can draw as and when you want on that pension, as well as 25% of that pension as a tax-free lump sum.
Right.
Now, it's worth pointing out there's been recent legislation that means there is a limit on the amount of tax-free cash you can take from your pension arrangements, and that would include your NHS pension and any private pension arrangements as well.
Yeah.
It's a reasonable amount. It's sort of £268,000, so it's a reasonable amount, but that is the maximum you'd be able to take from your pension. The What we would sort of say to some people though is if you're planning for retirement, but you still haven't made your plans. We talked earlier, it's really
Hmm.
difficult to think,
Hmm.
what am I going to be doing in retirement as a relatively young doctor? So you've got also ISAs on the side to think about. So individual savings accounts, you can put up to £20,000 into an ISA. And what we quite often recommend to individuals who still haven't quite made that decision is say, look, put the money away in an individual savings account. They can go in things like stocks and shares, so you've got potential for higher growth, although there are risks associated with those. But over the long term, it should outperform cash, but I should always put the proviso, no guarantees. Value investment can go up and down. I'm sure you've seen the adverts.
Hmm.
But from that perspective, that allows you to have that money on the side. And then if you decide, oh, I'm going to need access to a element of cash, you can dip into that before your minimum retirement age.
Okay.
If you
Yeah.
don't, you can then make that decision later on. Actually, what I'll do, that's been growing tax-free. So that grows tax-free. You can take that money out tax-free, and then you can place that into your pension and get tax relief up front and continue with the tax-free growth potentially.
So that's interesting. So we've obviously talked about NHS pensions. There's a possible private version of that, but kind of in between, ISAs offer a kind of do offer a tax-free benefit that sounds like it's quite flexible. And as you come to then at retirement age, you could then use that that money, you tax-free money lump sum you then get from your ISA. Could you then sort of buy a pension product with that, or
Yeah, there's two ways to do it. You can either just draw it out to supplement your income tax-free. So you get an income tax-free. You don't have to declare it in any tax returns. Makes it very simple. But if you've still got a few years to go, you could even put that into your pension, transfer it from the ISA into the pension. You then get the tax relief up front. The only difference you need to think about, although that sounds great tax relief, if you take it as income at the back end, you then get it taxed as income as well.
uh,
So
oh
it
yeah,
can work both ways, but you do get that 25% tax free.
yeah.
So it does work out more tax efficient. And if, for example, if you're 40% taxpayer when you pay into the pension, but maybe a 20% taxpayer when you draw it, it means you've had 40% tax relief, but you're only paying 20% on the way out as well. So there are different ways of planning so that hopefully you can save on the tax relief side of things as well.
Okay, okay.
Um, it's probably worth mentioning as well, which without confusing things, there's something at the moment called a LISA, which is a lifetime ISA, and that can also be used to supplement your retirement income because from your £20,000 you can put into an ISA, £4,000 of that can be put into a LISA as long as you're under the age of 40.
Okay.
Okay, there is a limit on age, unfortunately. Under the
Damn,
age of
go on.
40, but the government give you an extra 25% onto that LISA. It's quite a nice little bonus. And you can use that to supplement your income in retirement. You can draw it after age 60 and you can supplement your retirement income, or you can use that money as a deposit on your first home. So you have a bit
Hmm.
of flexibility. So it's really linked to helping people save for their first mortgage. But if they don't use it for that, they can also use it for their retirement.
And should they kind of need that money, can they take is it locked in? Can they not use it if
Yeah.
they
So the thing about the LISA is you can take the money at any stage, but if you use that money for anything other than a deposit on your first home or for retirement income after the age of 60, you have to pay back the 25% the government give you. So there's a bit of less flexibility there.
Okay, okay, but it's limited to £4,000 a
Yeah,
year.
per year.
So, okay, I suppose it's quite a nice narrow
Yeah,
risk.
I think for young dentists, sorry, dentists, what am I saying? Young
What's a
doctors,
dentist? Yeah,
I don't know where that came from. For young doctors, from my perspective, it's a great way of saving because it helps them build for a deposit for the first
yeah,
mortgage. And if
yeah.
they don't use it for that, then hopefully it will also supplement their retirement income.
Yeah, yeah, okay, that's good. That's something that wasn't available to me, I don't think. But no, that's interesting and helpful. Okay, so talk. We've gone through income protection and health and medical cover and some pension stuff. What now? I'm still thinking here of a relatively newly qualified GP now sort of starting to get some good baseline financial planning and stability in place. Then there is this thing that we often come across in life, which are called children, and family and spouses and partners and all that kind of thing. So what about it's always sometimes a bit difficult to plan for that. But what about things around sort of family investment products, family benefits, looking at children's long-term needs? And speaking as a parent of having put 4 kids now through university, and someone's invented this crazy thing called a master's degree, which they all seem to want. Where did that come from? Um, yeah. What about planning and investing for that?
Yeah, so I feel your pain. I've got university at the moment, so I know the cost, and yeah, planning for those sort of things early is the key. I get all these things. It's all about planning early, and it's
Mm.
quite often in people get financial advice almost later on in life when they get to retirement. We really need to start early. And there's two things you need to think about. The first thing is on the downside, and I know we're talking about saving for children, but you think about what happens if you're not about. So it's protecting your life and your partner's life, making sure that if either one of you aren't around and therefore not bringing an income, that there's enough money in the house to ensure that those children can still do the things you want them to do, like university, maybe deposit on their first home and that type of thing. And there's some very low cost type insurance out there that you can pay that will cost you literally 10, £20 for the majority of people a month. They're not huge costly products, but they give you huge peace of mind. And what they can do is protect you, and it's like a decreased insurance will protect the children throughout their period of time while they're dependent on you, up to the period obviously when they go to university, and then off out in the big wide world, obviously they're always dependent on you even after university. And then you've got to think about the cost of children. And we again look at different ways of saving for children. If you're looking for the child to save for themselves, then you've got junior ISAs, fantastic, up to £9,000 a year. They're just a great thing if you want to be put into savings for the children. You've maybe got grandparents, encourage them rather than give them cash, put into a junior ISA, because again, it gets some tax-free growth and hopefully better growth than they would get in a bank account. But then I'll keep coming back to ISAs. If you can encourage yourselves to think, actually, I've got a bit of disposable income, put them in those ISAs. They give you so much flexibility. If you've got a partner, that's £20,000 for your partner, £20,000 for yourself, up to £40,000 a year can be saved into those. And I can work from personal experience. Again, being the nerdy person I am, as soon as we had children, we put an amount each year into an ISA that we titled up university costs.
Right.
And we're now dipping into that to pay for things like student fees, etc. Trying to reduce the amounts of loans that the children are going to have through that ISA. And it's given us, we're not having to worry about paying for them out of our own income at this stage.
Mm.
So if you can afford to do that, it's great. And remember, if things happen that you're not quite expecting, you can always dip into it. It may be called university, but if the unexpected happens, you can still dip into it. So it's there's no restrictions on that. And even if you put it in a stocks and shares ISA, which we'd normally recommend for the long term, then you can still usually get hold of that money within 5 days. So there shouldn't be any reason not to go down that route of looking at ISA. But if you are looking to save an ISA for the long term, really recommend a stocks and shares ISA as opposed to a cash ISA.
Mm.
And then you would work very closely with an independent financial advisor to work out things, what amount of risk you're prepared to take and what timescales, and then you can find the right investment for you, because there are literally hundreds of different investments
Yeah.
out there
Yeah.
available as ISAs.
This you talked about this ISA that you called university fund. Was that in addition to the £20,000 you and your wife both had? Is it like in a
No. So
children's name?
that was part of the 20,000. So
Got you.
I just give, whenever I make savings, I give them labels.
Yeah.
As a financial advisor, I like to sort of
That's
give
really nerdy.
label.
That is
It
really
is. I'm
nerdy.
afraid it is, but I
Yeah,
do tend
no.
to give it labels. And I even got a filing cabinet with labels for each
Oh,
investment. What it,
bless.
I know, I know. I don't expect GPs to be quite the same,
Yeah.
but it works very much for myself.
Yeah.
And it ensures that it just takes a little bit of that stress away, particularly in university. We've got 4 children. You probably had the stress of 4 children in university. It's a
Mm.
huge cost now. And obviously you've got private school potentially as well, and trying to work out the costs of that now with additional VAT, etc. On private school fees. So in trying to plan all those different options with children, it becomes a real challenge.
Yeah, and sorry to sort of joke about the labeling and all of that, but it's now that I think that's a really important tip. I actually, many years ago, I forget the name of the book now. It was a book about to-do lists, and actually I started to do all my own labeling, and it's really paid off in trying to find all this stuff.
Yeah.
So it's worth investing a bit of time, probably, like you say, to really make sure you're filing all your documents in somewhere, even if it's in the loft. You can go back and get it, 10
Yeah,
years later. But
absolutely. And I'll give you one other nerdy tip if you like.
oh, go for it, go for it.
Hopefully, everyone's done a will. I I doubt they have, because wills are really important. Now, we don't advise on wills, but if someone's done a will, I will write on the envelope the will's held within where everything is. Where do you keep all your investments, savings? What are they for? Again, I'm afraid it's labeling, but if anything happens to you or your partner, it's so much easier to pick that document and know where things are, and rather than spending a fortune hunting around, employing solicitors trying to find information. So it's preparing for the worst, but if it does happen, the people you've left behind know where they're going to find their money.
I didn't, that wasn't in my mind as something to ask you, but that's obviously really important, isn't it? And wills are very easy to do.
Yeah, yeah, absolutely. They can be as easy or as complicated as you want. Uh, we usually try and uh, point people down the sort of the easy route. You can set up trust arrangements as well for children if you've got cash over and above sort of ISA allowances. But you can put things in cash, in trust, which can remove money from your estate. And again, make sure they're documented with any kind of will you've made. So we don't actually advise on wills, but we point a lot of clients in the right direction in respect to
Right.
making sure they make a will.
I was going to say, because that sort of advice from you is really welcome, because I imagine navigating that can be quite something.
Yeah,
No, fantastic. Okay, then, and I think we've talked about. I think we've covered ISIS off really nicely now. Then, so next thing about, I guess, is actually then, horror of horrors, one of us gets ill, or we become ill, and starting to take a claim on an income protection. And there's also, we haven't talked about critical illness cover as a thing.
yeah.
And so again, through your experience of advising clients over the year, what kind of advice has paid off for them in terms of preparing for illness?
Yeah, okay. So we talked a little bit about income protection previously. One thing worth mentioning, income protection what we call permanent. They call it permanent health insurance. And what that means is that if you make a claim on that policy, so say you claim on your income protection, you then go back to work, and maybe you're sick again in a year or two's time, you can claim that policy again. It means it's permanent. It doesn't stop after a
I
claim.
see.
That
Right.
is
Yeah.
so important. If you think about health insurance, when you renew your health insurance, they might take account of the fact you've had that claim. Permanent
Mm.
health insurance doesn't work like that. It just continues as long as you've got an end date, which is normally your retirement date, or 60 to 65, or your retirement date. But once you're covered, that cover can't be taken away, even if you make numerous claims on that. So that's a really important thing to understand, and that sort of goes on. You mentioned about critical illness. So critical illness is a policy that it's really important to understand. It's only going to pay out if you've had a condition that's classed as critical, or I'd say might well have killed you or can
Right.
kill you. So obvious ones are strokes, certain cancers, heart attacks, tumors, that type of things that are serious.
Mm.
And the idea of the critical illness policy is to pay out a lump sum of money to help you in event of when you've recovered from that condition, to help you get better in effect,
Okay.
or to pay off things like debt, so your mortgage. So most people have a critical illness associated with their mortgage, and the idea of that is you've had a heart attack, you've been off work for some time, you would have claimed on your income protection policy, you'd now have come back to work, but it could be that you're not wanting to go back full time, or there may be, because of the condition you've had. So you need to reduce your outgoings. The critical illness policy is there, paid out a lump sum, pay off your mortgage, reduces your outgoings, hopefully give you some more cash as well, that you might want to make some readjustments to your lifestyles because of what's happened. And that
Okay.
payment tax free as well.
So these income protection plans, permanent income protection plans, and these critical products, they're not. So they think about them as they actually do a job just to keep you going. They're not like I've got cancer. That's really bad news. But yeah, I'm going to get a lottery ticket and get a load of cash. It's not like that.
No,
These are just to keep you okay, right?
yeah, and it's worth pointing out as well because the cost of critical illness is about 4 times the cost of life assurance.
Oh,
Okay,
life.
so it's
Okay, yeah,
more expensive, and that puts people off. But the reason why is
yeah,
you're over 4 times more likely to claim on your critical illness than you do on your life assurance.
right,
Most people, I know you think, well, you might not have a critical illness, but you're definitely going to die. But most
yeah.
people actually die after their life assurance policy has elapsed. Um, but the critical illness is obviously during a period where most, you probably know better than me, the peak time for people to have heart attacks is probably in their late 40s and times like that. So that's when you'll have your critical illness policy and you're more likely to claim on it. But most people have retired when they pass away and they've sort of stopped all their life assurance. So critical illness is quite important. And we've got a lot of examples of people who are extremely grateful for having that critical illness policy that were probably a little bit skeptical when they first took it out.
Yeah. Well, we're always skeptical about our own mortality, but
Yeah.
reality always bites, doesn't it?
Yes.
No, that okay, that's good. We mentioned mortgage again, and just then, and just sort of cycling back a bit. We touched on sort of starting to think about allocating money when we first start earning into mortgages, but just I guess a couple of worth spending a couple of minutes on actually um, um, we right. We've decided now. Time is right to buy our first house. And get a mortgage. As a locum GP, what things do I need to do? Do I need to know?
Right. So locum GPs are probably one of the challenges in life and getting a mortgage for, being honest. Because of the nature of your work, nature of the income side of things, there are some mortgage companies out there that aren't very comfortable with that way of working. They want someone that's got a regular income, regular job, going to get paid the same each month. However, there are some mortgage companies out there that love this type of thing, and
Okay.
they realize, well, let's face it, GPs, they're qualified, they're professional, they've got potential to keep earning. It's not a regular income, but they've got job, they can get work. They're not really worried about the risk.
Mm,
Um, so you need to find one of those mortgage companies. So we have a mortgage desk which specialise in giving mortgages to doctors. So they know the ones to go to save, sort of going around the houses and trying to
mm,
find the right one. So what you need to think about first of all is your deposit. How much money are you going to put down on your mortgage for your property? The bigger deposit you've got, the lower the mortgage rate you'll pay. So you might be able to get a 95% loan to value mortgage. It's possible, but the mortgage rate you're going to be paying, the percentage interest you'll be paying will be very, very high.
mm.
So we would normally recommend if you can get anywhere in the region of 20% as a deposit, then that's going to give you a lot more choice in respect of mortgage rates and deals available and paying less each month
Yeah.
for that particular mortgage. Um, Other things to think about, make sure you keep, as you've already said, you've got systems that's great records of your income. It's clearly documented. Make sure you pay things like your credit cards on time. Make sure you pay your tax on time. Make sure you pay everything you owe on time, because then you are reducing your risk to the mortgage lender, and
Right.
they'll
Because they do all these
actually,
checks, do they? They check on that.
yeah, they'll do all this checks. They'll go and they'll do credit checks, and they'll see. And if you've got any debts outstanding, or if you paid even a credit card late once, that will show up. Um, and what we'd say as well is have two on the opposite side, a bit bizarre, have one or two credit cards or even three credit cards. Because if you can demonstrate you can manage your credit cards, that puts you in a high position as well from a
Right.
credit rating perspective. Uh, Bizarrely, you might not have any credit cards because you work on a basis. So I don't really trust those, and we have people who just basically pay all their bills out of their bank account. They don't use credit cards. Yeah, they actually may be seen as a slightly higher risk because they haven't
Uh-huh.
got the lender can't see a record of you paying off things like credit cards. They can't see a record of how you deal with credit.
Yeah.
So they see you as a slightly higher risk. So credits, as long as you pay it off, is actually quite a good thing. If you've got things like car loans and other bank loans, try and pay those off as best you can before you have the mortgage, because that reduces the amount you can borrow.
Okay.
And if you're currently renting before you go and get your first mortgage, just make sure that everyone in that household that you're renting with has been paying their bills and debts on time as well, because they'll check that property. And if anyone's not paid their bills, or if they've got arrears or something like that, that will go against you on that property, and you will have a
Really?
problem trying to persuade a lender that it's nothing
Yeah.
to do with you.
Heavens above. So they
So
really want you to be you and where you live to be financially absolutely squeaky clean, low
yeah,
risk, demonstrating you're a very good person who pays off.
exactly. You may well still get a mortgage, but every time there's a problem, they'll just bump up that interest rate, or the number of choices you've got reduces, and you
Yeah.
end up paying a little bit more. So as long as you can demonstrate you're really low risk, that's what lenders want. And if
Heavens
you
above.
demonstrate that, you'll pay a lot less as a mortgage payment each month.
My son, who's actually 31 today, he's self-employed, and he had a mortgage lender turn him down because he had some sort of bank account at some stage years ago, which did a thing, a Bitcoin offer. So he had like about £20 or so, he reckons, put into his bank account. But because it was Bitcoin, the lender couldn't demonstrate where that money came from, and therefore he was excluded from that product.
Yeah,
And I suppose that's just again another example of being so fiscally clean and perfect. And yeah, okay, that's really interesting.
absolutely, absolutely, yeah. What we'd suggest as well, if you are looking to get a mortgage in the next couple of years, you don't have to be in a situation now. You could contact our mortgage team, and what they do, they give you guidance on what to do with the next year or two in
Oh,
order to get ready for your first mortgage. They'll be more than happy to do that. So if you just go on the Chase de Vere website, we'll be delighted to help. There's a mortgage section. Click on there, gives you a contact, and phone them up, tell them your situation. They'll say what you need to do is X, Y, Z, and you should be in position to do a mortgage at this stage.
nice,
They're really, really
nice.
use, really, really
So
helpful.
pre-mortgage planning, that's a really good
Yeah,
idea.
there's no cost for that as well.
And and I think for the last thing really is about, I don't think we need to spend too much time on it, but it's talking about actually now actually starting to draw your NHS pension. We've now these hardworking GPs have been working full time or part time with freelance GP locum work. It's now coming to a significant birthday coming up. How do we go about that? I think just briefly, but also there's the McCloud thing. Just again, no detail really, but just what do we need to be aware of, bearing in mind that this is such a complex time that I'm sure we're going to be this needing to talk to a financial advisor
Yeah,
about that.
like the way you said briefly there, probably one of the most
I
complex
know.
elements. um, yeah, so retirement used to be fairly straightforward. You'd reach your retirement date, you'd send in your AW8, which is your retirement form, and you'd get paid your pension by the NHS. Unfortunately, it's a little bit more complicated than that now. I'll start with the McCloud bit and then explain about the retirement. So many of you may have heard of McCloud, some of you may understand it, some of you may not, but in a very brief explanation. If you were a member of the NHS pension scheme before the 1st of April 2012, that's a real key date, you're affected by McCloud. So if you join the pension scheme after the 1st of April 2012, this next little bit doesn't apply to you. But if you're affected by McCloud, what will happen is for your pension that's been purchased between the 1st of April, sorry, to get this right, the 6th of April 2015 through to the 5th of April 2022, that's 7 years of your pension. It's called the remedy period. You'll have a choice at retirement on how you want that pension paid and from which pension it will be paid from. So what will happen as a default, your pension at the moment will be held within the 1995 scheme, or if you're a member of the 2008 scheme, it will be held within one of those two schemes for those 7 years. When you reach retirement, you'll get a letter and it will say, okay, this is your benefits, assuming you're in the pension for those 7 years in the 95 or 2008 scheme. Or if you prefer, we can give you a pension with those benefits in the 2015 scheme. and it will show you a comparison. Unfortunately, that comparison is quite complicated because the 2015 scheme, for example, doesn't have an automatic lump sum, whereas the 95 scheme does. They have different retirement ages. So the 95 scheme is 60 as a standard retirement age. The 2008 scheme, 65. The 2015 scheme, state pension age. So to compare for like is really quite difficult, but you will have those options. The good news is, again, we, for example, can do analysis and work out which is the best option for you. Some of it will be, some of you it will be fairly obvious when you get your statement. For a few of you, it will be obvious, but for some of you, it really won't be obvious which is the best option for you. But you make that choice at retirement. You don't have to do anything now about McCloud unless you have a taxation issue. But from retirement's perspective, you make that choice when you physically get your retirement options. Many of you may have got you, if you're fortunate enough to have your pension statements on an annual basis, and it will show the difference comparisons as well for McCloud for you. So it calls it standard benefits and alternative benefits.
Okay.
So that's sort of McCloud. Does that make sense,
Yeah,
Richard?
no, I think that's probably, I think, all we kind of need to know at this stage.
Yeah.
There's that statement, and then it's based on that, which is I guess is automatic, and then we make a decision based on that when we get it.
Yeah. Yeah. It's worth just pointing out, and I appreciate that. And I'll be honest here, in respect of getting those pension statements for GPs, particularly, is a challenge because the records are never up to date. You could find that you get paid what called a second bite pension later because that's just a pension they're paying you extra that they haven't managed to have the details of because the accounts are done later for GPs. So we spend a lot of time with GPs at that stage in trying to get things right. It is particularly complicated.
Yeah, I don't think that's my stage. As like I say, I've been 60 now for 3 or 4 months, and I still haven't had my McCloud stuff come through. But I'm just,
Yeah, you,
it will turn up.
it will turn up, and I think they've got two deadlines. One's 2027 and one's 2030 for those
Okay,
who've already retired. But yeah, we can talk people through what those options are. And then you've got things like partial retirement available now, which is a new flexible arrangement. So you don't have to actually take all your pension in one lump sum now from the NHS. You can actually take part of your pension, maybe continue to work, maybe doing part-time, and then draw the rest of your pension later on in life as well. So
right.
loads more flexibilities with NHS pensions now than we had a number of years ago.
Okay, more flexibility, more complication by the sounds of it. So,
Well, yeah, I'm afraid that's what comes with more flexibility,
yeah,
is a bit more
yeah, yeah,
complication. But actually, that side of it is really good news in respect to the pension. Giving that flexibility to doctors, I think, is really, really good news. But it obviously does come with a bit more complexity, unfortunately.
yeah. Great. Um, Fine, lovely. Okay, so and then you mentioned you touched on the AWA. Do we need to dive any deeper into those people who are approaching pension age? What's a few sort of tips on what to start thinking
Yeah,
about and how to start planning?
yeah. I think when you're getting towards retirement, well, there's a few milestones, I suppose. When you get within 5 years of retirement, I think it's really important to check your pension records up to date. There's lots of things I would get someone to help you in respect of that, but I'd be getting in touch with PCSE and NHS England, making sure your pension record's up to date, and start mapping and planning what you think your pension's going to look like. When you get within sort of 6 months, about 6 months from retirement, and you're thinking, yeah, I'm going to retire now, that's when to apply for your pension, and you submit a form called the AW8, which you submit the form, and that will provide you with all your pension options. Just that's basically just saying, look, I want to draw my pension now. If you're taking partial retirement, so you don't want to take all your pension benefits, there's another form called a supplementary form which you'll need to complete as well. There's some calculators you might want to play around with on the NHS website as well. We can talk you through those just to help you sort of decide if you want to take your pension in full or partially. But I think the 5 years from retirement is a really important time to start your plan, and we do have a running down plan we talk to doctors about. We do 5 years, 4 years, 3 years, 2 years, and make sure they're on track. Everything's there so that when they do apply for their pension, there's no holes in their pension record. They pretty well know what to expect by that stage. They've already made their plans for what's going to happen when they do retire.
Fantastic, brilliant. That's really. I think that I think that covers off the pension nicely. Because I say it then starts. There are so many different nuances and varieties. It comes to actually then people need to start really looking at the fine detail, don't they?
Yeah, yeah. I mean, a lot of it is making sure you're not surprised when you reach retirement. You send off the AWA and they come back and said, "Sorry, we haven't got your pension record up to date. We can't give you any figures." That happens all the time. So it's really important to be ahead
Yeah,
of the
okay.
game with that and make sure if they haven't got your record up to date, get ahead of it. 4 or 5 years ahead of it, and make sure that when you do come to retirement, that they have got your record up to date.
No, fantastic. That's wonderful. I think what I'd really just like to sort of finish on really is a bit more just about independent financial advice. I know there are how is it paid for? How do we choose an independent financial advisor? Do we are we paying a fixed cost every year for your services? I mean, there's no such thing as a free lunch. Or are you taking where how do you make a living, and why is that sort of overall balance a net
Yeah.
positive for us to get that
Okay.
advice?
But the first thing, whenever you are choosing a financial advisor, make sure they're transparent. That's really important. With charges. If you ask for the charge, they say, "Oh, well, we'll cover that later." No, ask what the charges are, because it's really important to be transparent. And from our perspective, you can pay for our services a number of ways. You can pay a fee. You can pay if you're, say, managing your pension or managing your ISA, you can pay from that particular investment via a monthly deduction from that investment. Uh, you can pay like an annual fee, or you can pay for one-off advice, ad hoc advice. Again, could be a fee for that particular advice. And how we tend to work is we'll have an initial consultation where there's no fee for that. Advisor will sit down with you, find out what your circumstances are. They're not going to give you loads of financial advice at that stage, because they'd really just find out what are your priorities and what is
Right.
your situation, what's your pension looking like, what's your life. But from that meeting, they then should be able to give you an indication of what the costs would be and what the fees would be going forward. And then at that stage, you'd sign what we call an engagement letter to say that makes sense. You're happy with that particular cost or fee
Right.
at that stage. So that should sort of be fairly clear. Also, at the end of that meeting, it's really important that you might end in that meeting and be honest. You might think, actually, I'm not sure I want to work with this financial advisor, in which case you have a choice to go and it hasn't cost you anything. Or you might think, actually, this guy really knows his stuff. I like this guy. This is someone I want to help me through the retirement conundrum. In which case you're happy to pay those fees. But we're very clear. You can look at things like our trust pilot score and stuff. Have a look at one of our advisors, give it a go, and hopefully you'll like them. If you don't, walk away. There's no fee at that stage. It's just probably investing an hour and a half of your time at that stage.
That's fantastic. So that 1 to 1.5 hours, it's during at the end of that you'll know what your fee is, what the payment structure is going to be for the cost for that. You
But for
can't.
you particularly, yeah, we'll show you what the cost is, and the advisor would show you, what the hourly cost is if he goes forward, or what if it's 1% of investment fund or whatever it may be. They can do that at the front, but for your specific area, what in terms of how I'm going to advise you, this is going to be the cost for you as an individual.
Yeah, fantastic. Okay, and so the very last, just one last question really is, so someone listening to this has not really been on top of their financial management for the last 10 years or so. What things should they start doing today to just really start to get on top of things?
Well, the obvious one is contact the Chase TV financial advisor.
Brilliant.
Obviously, you can go on our website for that. But I would say, if you've not been on top of anything, the first thing is, and again, nerdy bit, get all your paperwork out, get it your ducks in a row, find out what you have got first of all. We've had people who've got two lots of income protection policies and savings they didn't know they've got, because they take out policy. I haven't checked what they have got. So get all your ducks in a row, see what you have got, try and work out what you're concerned about. Um, think about what element of risk you're prepared to take if you've got savings. So one thing we do find, young doctors quite often, they maybe inherited some money or they've got cash and it's been sat in a bank account for a year or two. And really that's almost cost them money by having a
Yeah.
bank account. So, set it all out and think about, what do I need to achieve with all this? And then make a list and say, right, these things need to go through. And if at that stage you need to speak to a financial advisor, I would suggest get a financial advisor in, go through everything in some detail, and then start making your priorities with them, because they might actually make your priorities slightly different when they talk to you. They might say you might not think about that. Most people worry about their savings and whether they make enough money in savings, but they haven't actually protected those savings with a protection policy of any kind.
Phil from Chase Vere, thank you so much
Well,
for
thank you for inviting
taking.
us.
No, thank you for taking all those questions as well. That's been really interesting. I hope I've covered everything, but we'll see. And in the note section of this YouTube video, under the note and all the podcast in the show notes, we'll have all the necessary links and contact details and all that kind of thing in there as well. So again, thank you so much for coming along today, and we'll see how things go. But it may well be we might need to pick up some threads depending on what sort of contacts and comments we're getting from our colleagues. Thanks.
Yeah, I'll be
Thank you,
delighted to
Phil.
do that. Thank you very much. Yeah,
Thank you.
thank you.